As promised, let's talk about markets, where we are headed and how do we navigate the turbulence, this tariff turbulence that we're seeing. Seshadri Sen from Emkay Global joins in with his thoughts and perspective. Mr. Sen, always a pleasure chatting with you. This is Reema here. Open-ended question. You've had 48 hours to think about this. What is your advice now? 25 plus 25 as we stand now.
Hi, thank you for hosting me on the show. In the short term, my short and sweet advice is do as little as possible. Do not try to trade this news flow because you can get whipsawed in either direction very, very badly. Things could turn on a dime. There are multiple cross currents which could take this the tariff story in either direction. Over the longer term, yes, this is incrementally a negative for India, and there is a potential for some level of derating, but I don't think that this really impacts the longer term story. From a 6-month plus perspective, we continue to be constructive on India as a market, and would additionally, because of this uncertainty, focus much more on domestic facing sectors. Be very careful of investing in globally exposed sectors, not just because of the tariff regime that has come in, but because once all the tariffs settle down, we are expecting a sharp global economic slowdown. So tariff or no tariff, I think it is time to be a little careful about export oriented and global facing sectors. As far as the domestic sectors are concerned, the primary driver of that is the aggressive monetary easing by the RBI. I know there was a little disappointment that they did not cut earlier this week, but that's not a problem because they've done enough so far, in our opinion, to trigger a cyclical consumption recovery in the second half of this financial year. It just will take a little more time to percolate through, and we expect sharp improvement in retail credit offtake, driving discretionary consumption. So our focus remains on domestic-oriented sectors like the consumer discretionary and to some extent industrials.
Got it. Seshadri, you are saying even if there were no tariffs, it is not the time to look at markets from a fresh buy perspective. At what level would you be comfortable? How much more does the market have to fall for you to be comfortable in terms of valuations for a fresh buy?
So there are two scenarios here. One, if the market corrects by more than 5% from here, I think that's a time to aggressively re-enter the market, with the caveat that I said earlier, focus on domestic-oriented sectors. Or give it a little time. Let's get closer to the festival season. By then, there will be clarity one way or another of how the trade scenario and the tariff scenario works out, and that time, selectively start nibbling again at domestic-oriented sectors.
So Seshadri, you mentioned if there is a 5% decline, you can aggressively enter. But do you see that potential of a 5% decline? Of course, 5% in a market like this, in a scenario like this, may not be too much. But do you see such a potential to happen?
First of all, no, I don't think 5% is small. 5% correction in the broader market would mean that, in the smaller cap universes, you'll see many stocks correct 15 to 20%. So 5% in the Nifty could be a fairly major correction. It's not in our base case. We don't see that happening. All the bad news is already in. How much worse can it get in terms of a scenario? The only way that could happen if there is a sudden sell-off in the rupee, and that would trigger FPI selling, and it could potentially bring the market down. But we've also seen the domestic flows, especially with falling interest rates, will remain robust. So no, not in our base case. It's just a what-if scenario. If you do get more than a 5% correction, that's the time to buy. But most likely is that the markets will time correct from here for the next 3 to 6 months.
Okay, 3 to 6 months time correction, or we could see at best a 5% correction, which would be a time to buy. Why are you so confident that, in the second half of the year, the domestic story is going to stay intact? And secondly, do you expect any sort of, relief coming in from the government? I mean, there is some chatter that on the 15th of August, we will hear something by way of reforms. which have sort of been absent. Are you in that camp? Is that something which we need to revitalize, domestic growth?
Let's answer second question first. I don't think structural reform can be switched on and off. There will be plenty of forward movement on many areas. Maybe some of these could see some acceleration. More likely, if the final tariff scenario does turn out to be very adverse for India, the government may be forced to accelerate a stimulus. Historically, the government has been unwilling to give a large fiscal stimulus. The preferred route is monetary stimulus, and therefore that may get accelerated. But yes, a response to this, in the immediate response to this, is more likely to be a stimulus rather than accelerated reform, because reform takes time. That's not to say that there isn't a case for accelerating reform in many areas and pushing that through, but that's not an immediate solution to the shock that the economy faces because of the higher tariffs.
Okay. So Seshadri, while we are talking about reforms, domestic facing sectors of course have seen a positive impact of that, be it some of the sectors like defense as well, and the ones that you mentioned because of higher domestic demand. What are some of the sectors you're not bullish on? Maybe because of valuations, maybe because of demand concerns, or maybe because there are no fresh triggers from here on for them.
Financials and technology are two sectors that we are underweight on. Technology, first of all, technology, you have to trade the multiples. It is the only time you make money in technology in the post-COVID world is when you have valuations on your side. We still don't, when it goes to say -1 standard deviation, that is a good time to look at technology. So one such opportunity presented itself on the day of the Trump pause. The other sector is financials. Large banks, we think, are growth challenged, and valuations do not reflect that. In the shorter term, they are facing margin pressures, which is further affecting their revenue growth. So we've been structurally underweight on lending financials for quite some time. We remain so. We would look at that sector only in a selective stock picking basis and not as a broad brush overweight on the sector.
Seshadri, pleasure having you as always. Thank you so much for sparing time and joining us today with your views on what next for the Indian markets after Donald Trump's tariff tantrum. Well, take a short break here, but just before we do that, remember to tune in to the all-new CNBC TV18 Prime, which brings you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 this evening.
These beings are looking at that. One thing I have choosing different. फिर बात होती है एक पत्ता होता है